Ever wish you could have your cake and eat it too when it comes to investments? Get both income and growth.
Right, the best of both worlds.
Well, today we're diving into a strategy that claims to do just that.
Should be interesting. Let's see if it lives up to the hype.
We're taking a close look at the Allspring Global Equity Enhanced Income Fund, using their own fact sheet and a recent manager update.
Always good to go straight to the source.
Exactly. Think of these documents as their sales pitch to potential investors. So let's unpack this Allspring Global Equity Enhanced Income Fund.
Sounds like a mouthful.
It is a bit, right? But it basically boils down to their stated goal: high income and long-term growth, primarily through global equities.
Ambitious, for sure. Achieving high income often means sacrificing some growth potential, and the other way around, too. So how are they going to balance those two objectives?
That's the million-dollar question, isn't it?
At least a few billion based on their assets under management, but yeah.
Good point. Okay, so they lay out their case in three key areas: product, people, performance. And under product, the first thing they highlight is this differentiated offering of a 6% target payout.
6%, that definitely got my attention.
Right. And they break that down further, saying 4% will come from what they call high-yield equities, and the other 2% from an option strategy. Can you shed some light on those income sources for us, especially that options overlay?
Sure. So high-yield equities, they're essentially stocks that pay out higher dividends than the average company.
Okay, so more established companies, not necessarily high growth, but with steady cash flow.
Exactly. Think of companies in mature industries, maybe not expanding rapidly, but they generate consistent cash flow that they can return to shareholders as dividends.
Okay, that makes sense. So a bit more of a steady eddy. But what about the other 2%? Where do options come into play?
Think of options like side bets on the stock market.
Side bets. Okay, this is where I sometimes get lost.
It's not as complicated as it sounds. With this overlay, they're basically selling other investors the right to buy or sell their stocks at a certain price in the future.
Interesting. So they're making money by selling these rights, even if the stock price doesn't move much.
Exactly. They collect premiums for selling these options, and that's where that extra 2% income stream comes from. But of course, there's always a catch.
There's always a catch, right? Let me guess. If the market moves against them, they might miss out on potential gains.
You got it. If the stock market takes a turn they weren't expecting, they might have to give up some potential gains to cover their options positions. It's all about managing risk and reward.
So it's a balancing act. Boosting income, but potentially limiting upside. Fascinating. Now, under their process section, they talk about dynamically managing those two income sources. What does that look like in practice?
It means they're not just passively collecting those dividends and options premiums, they're constantly reviewing and adjusting.
So not just setting it and forgetting it.
Definitely not. They're actively managing that portfolio, buying and selling stocks, and fine-tuning that options strategy to make sure they're still on track to hit that 6% target payout. But also, they want to make sure they're well-positioned for potential growth.
So they're trying to stay one step ahead, adapting to the market.
Exactly. It's like they're juggling, trying to keep all those balls in the air. And speaking of juggling, they're aiming for a concentrated portfolio of 60-80 holdings. And here's the thing. There's no fixed bias towards specific company sizes or investment styles.
So they're not putting all their eggs in one basket, so to speak.
Precisely. They're casting a wider net.
Yeah.
And they mention using both quantitative and fundamental analysis to select their stocks.
Now that's where it gets really interesting for me. How do those two approaches work together?
Well, that's where the people part of their pitch comes in. They have a team of 7 portfolio managers, each with their own area of expertise. It's a real brain trust.
7 minds are better than one?
Exactly. So you've got the quantitative folks, they're crunching numbers, looking for trends, building models, all that data-driven stuff. And then you have the fundamental analysts who are digging into company financials, meeting with management teams, and really trying to assess those long-term prospects.
So a good mix of data analysis and good old-fashioned gut instinct.
You could say that. And the idea is that this combination leads to better, more informed investment decisions.
7 portfolio managers. That's impressive. But as with any investment, I imagine there are risks involved.
Oh, absolutely. Every investment has its risks.
And in their fact sheet, it's the cost section where those risks really come to light.
It's true. That section is all about setting realistic expectations.
Yeah, it feels more like a manage your expectations section,
Transparency is key, right? Got to give investors a clear picture.
Right. And they're upfront about the fact that this fund is still heavily invested in the stock market.
Which means volatility is a given.
Exactly. They actually caution investors to be mindful that the fund is an equity strategy and will likely experience periods of heightened volatility and drawdowns.
Buckle up. It's going to be a bumpy ride.
Yeah, smooth sailing here. And then they add, in addition, the fund gets a sizable portion of its income from option call writing strategies and can underperform during strong bull markets.
There it is. That's the trade-off.
So even when the market's doing great, this fund might not keep pace.
It's a possibility. You see, selling those options generates that nice income stream, but it can limit the potential upside.
How so?
Well, let's say the market takes off and their stocks skyrocket in value.
Okay, sounds good so far.
Right. But here's the thing. Because they sold those options, they might be obligated to sell their stocks at the price they agreed to beforehand, missing out on some of those gains.
I see. So it's a bit of a balancing act. They're striving for that steady income, but it might come at the expense of some growth potential, especially during those bull markets.
Exactly. Risk versus reward. Right.
Right. So how can an investor know if this trade-off is the right move for them?
That's where digging into the fund's track record is crucial.
Looking at their past performance.
Exactly. Ideally, you want to see how they've weathered both good times and bad. Look at their returns over a period that includes both bull and bear markets. See how they compare to benchmarks or similar funds.
So don't just focus on the sunny days.
Exactly. You want to see how they handle those stormy days, too? Have they consistently generated that income without sacrificing too much growth? These are all key questions to consider.
Makes sense. And it's not just about this one fund either. They even emphasize that in their fact sheet. They say investors should ensure that they construct their portfolio to build more diversity and avoid concentration risks.
Diversification is key. It's all about spreading your risk.
So this fund could be one piece of a larger puzzle.
Exactly. It's not a one-size-fits-all solution. It's about how this particular fund fits into a broader, diversified investment strategy.
Right. So while this Allspring fund seems like it offers this enticing combination of income and growth, it's not without its risks and potential downsides.
No investment is. It's all about understanding the trade-offs.
Exactly. It takes careful consideration, thorough research, and a good hard look at your own risk tolerance and investment goals. Speaking of research, let's shift gears a bit and dive into that manager update document. They talk about this systematic edge platform, and the numbers they throw around are pretty eye-catching. 21.9 billion in assets under management.
That's a lot of zeros.
That's what I'm saying. And another 6.5 billion under advisement.
So clearly their approach is resonating with a lot of investors.
A lot of zeros indeed. So their systematic approach seems to be attracting attention, but what does it actually mean? What are they doing differently?
That's a great question. And to be honest, this manager update is a bit light on the specifics. I'd love to see some more detailed data on their long-term performance.
Yeah, how those returns actually shake out.
Exactly. Past performance isn't a guarantee, of course, but it's definitely something you want to consider.
Absolutely. Now, they do highlight Eddie Chang, their head of international.
Interesting.
Right, but
Yeah.
they don't really delve into his specific insights.
It would have been fascinating to hear his perspective, especially with this fund's global reach. Maybe something for a future deep dive.
I'm adding that to the list. But even without that extra layer, I think we've gleaned some valuable insights today. We explored their unique approach to generating both income and growth, using those high-yield equities and options strategies.
And we talked about the potential trade-offs, right? That balance between risk and reward.
Exactly. And how crucial it is to consider your own risk tolerance, investment goals, and, of course,
Diversification.
always. This fund could be a good fit for some portfolios, but it's all about finding the right pieces for your own personal puzzle.
Couldn't have said it better myself. It's all about finding those investments that align with your individual financial goals.
Exactly. So as you continue on your investing journey, think about what we've discussed today. Ask yourself, does this kind of fund, with its potential for high income and growth, but also with those inherent risks, align with your personal investment strategy? Something to ponder. Thanks for joining us for another deep dive.